Hello, Jimmy.
Jeremy, how are you?
I'm doing well, thanks. We are in the third quarter here.
We
It is
are?
July of 2025, and we're back again doing the market insights. Happy to be here. Lots to cover as usual.
Oh, yeah.
It's going to be fun. We got a full docket here.
Let's go.
The big portfolio points. Try to get them fairly squared up in three different areas here. The one big beautiful bill. Great name. Great name. So there's a lot to unpack there.
Yeah.
That's a 900-page bill.
Right.
We've just started to chip away at it, but we want to share some highlights. Then we got this tariff mulligan.
Yep. I love the golf
I
terminology.
know you do. That was for you.
Yeah, I appreciate that.
So, and then just good news, right? There's some market good news and otherwise. So we'll get into that and end with that on a great note. All right, here we are. The One Big Beautiful Bill Act, as it is officially called, or the OBBA. I guess I don't know how it's going to get,
Yeah.
characterized. We'll
Right.
see,
Yeah.
right?
Somebody will figure something out.
The crux of this is that it's a continuation, first and foremost, of the Tax Cut and Job Act
Right.
from 2017.
Correct.
So it's an extension to permanency for a lot of the things that were done back then, that were on a 10-year cycle, correct?
Which that is, I think that was certainly like the most impactful part of this from a planning perspective, right? Because we had this sort of unknown, are we reverting back and sunsetting to the 2017 tax laws, or are we going to get an extension or permanent extension of the new rates that had been put into place in the Tax Cut and Job Act? Not just what the reduction of the rates, but also the widening of the brackets was a big deal.
For sure.
I think again, as the Tax Cut and Job Act came out in 2017, it was effective in 2018. There's a lot of material to dig through and comprehend, and then start to plan for. And we're going through the same process again here. But that big portion of it, as we now know, is an extension of what we've been living in. So
yeah, that's the base, and that is like, it's really more than 50% of the story here.
Yeah.
But what we're going to give you is the additional items here, some highlights, right? This is thick. This is from our friend Steve Bonaventure, CPA here in Northville, Michigan.
Yep.
He does a great job, and he put together this summary. So we're leaning into some of his research here. Let's just get after some of the high points, right? So the standard deduction is going to increase for single and for joint filers.
Yep.
It's already been pretty robust, right?
Yep.
It's also worth noting that these things in here, they don't start until 2026.
Right.
Okay, so this is not for 2025. 2025 is what it is.
Yep.
Child tax credit's going to increase. Mortgage insurance premiums, more to come on that. The 529 plans, it's now used up to $20,000 in your pre-college environment, your elementary and secondary. There could be some tax implications here on the state level that you need to be aware of.
Very much so. As we know, every state has their own 529 plan. So the caution there is make sure you understand your state's rules around 529 plans.
If you guys need help with that, we can dissect that for you. Deductions against Social Security income. So if we harken back to last year, and we had all the election and the promises that were made. Well, this is sort of a Donald Trump promise to eliminate Social Security income, but let's not go that far. They didn't eliminate Social Security income, but they're giving you a deduction.
Correct.
So there's going to be a lot of details coming out on this. There is a lot of misinformation out there, as Steve points out, and I think that's so true. Social Security tends to, magnetize so many eyeballs.
Right.
And there's a lot of people out there willing to take advantage of people and kind of give them advice or insights that necessarily aren't true.
Well, that's one of the things that has frustrated me the most in financial planning as a whole in my entire career is talking to prospects, clients, friends, and family about Social Security, and they heard from a neighbor or a friend or a coworker or somebody who's not an expert on this that gave their opinion on it, and they think that what applies for one should apply to all. This is a very personal and customized decision, and understanding Social Security, it's far more complex than it probably should be.
Right.
But nonetheless, it is the way that the tax on this is working is going to be different for different folks. And it's just important that you understand where does Social Security income fit within your financial plan and your income and retirement, so that you can make the best planning decisions once you know how it's going to apply for you.
Right. Along those lines, we just really want to say to people, like, Social Security is a really important thing. It's important to understand some of the ins and outs before you make a decision on taking Social Security.
Right.
And then understanding all the different deductions now that you can have against, and the tax implications that you have with Social Security.
Correct.
So, next one on the list, charitable contributions. This one's kind of interesting to me. Is above the line.
Yep.
You used to be able to take $600.
Right.
And you could basically do that without worry of getting audited.
Right. Yep.
Right. Now it's $1,000 or $2,000 for joint filers.
Yep.
So there's a savings opportunity right there for people. Next one, this is right in your camp, the SALT deduction.
So this is one of the ones that, in the Tax Cut and Job Act, there was a $10,000 cap on your SALT taxes. So SALT is your state and local. So whatever taxes you pay, income tax you pay to your state and the property taxes that you pay in that state, you used to be able to deduct all of it if you were itemizing. You could combine all of the state income tax and the property taxes, and they were totally deductible. But then in the Tax Cut and Job Act, we limited that, and they put a $10,000 cap. Whether you were single filer or married, filing jointly, it was $10,000 for both. So they it's viewed as like a marriage penalty, is how it is typically referred to in the tax terminology. But so if you think about some of the states that have higher income tax rates, it was very penalizing, the Tax Cut and Job Act, for some that, for the high income earners that were paying a lot in state income taxes and property taxes. Historically they had been, writing off substantial sums of money they had paid in income taxes and property taxes, and now you're getting 10,000 cap. It was a big deal, and it upset a lot of people.
No doubt.
Right? So here we see, we're going up to $40,000 is now the cap. Again, now you need to, understand that there are income limitations to this that will phase, some folks out of that. But nonetheless, $40,000, that was, a big part of the debate over this one big beautiful bill.
Right. Remember, SALT deductions really are utilized as a tool when you're itemizing.
Correct.
Right. So not when you're taking the standard deduction. And then there's other things in there. We've kind of noted those here below: deduction for qualified tips, tax deduction for overtime pay, car and loan interest deduction. Lots of stuff.
Yes.
We're not going to get into all of it. We are, however, going to take a little deeper dive on some tax planning associated with this. So again, if you're sort of bored at this stage in the game, stick with us. We're not going to stick on taxes the whole time, but we do a lot of tax planning at On Track Wealth Management, so we want to give credence to it. So a couple things that we've kind of looked at here specifically are going to be with respect to Roth conversions. So Roth conversions is a very good tool for creating long-term value for clients. And there's some issues here that are going to crop up. One of them is there's a new senior deduction that did not exist before. So you're over 65 as a single individual filing singly, you're going to get an additional $6,000 of deduction. If you're a married couple filing jointly, it's $12,000.
Right.
If you're both over 65. Great, right? But there's a phase out on this for the deduction. And if you think about it, anytime you take an IRA and you convert it to a Roth, that's going to be seen as ordinary income, which could burst you up into this category and phase you out of these deductions. You have to be aware of that, right?
Absolutely. Yeah, that's, you don't want the tax tail to wag the dog, right? But, you definitely want to make sure that you're running, proper projections on all of the decisions you're making from a tax planning perspective. It's just now with these new wrinkles, there's new planning, new legislation, new planning opportunities.
Yes, agreed. And it could be as simple as it makes the pre-65 conversions
much more valuable,
even more valuable,
right?
If you want to take advantage of these things,
right?
By the way, you're never going to optimize everything. The tax code is way too complex. But if you can hit most of the marks and
Yeah.
hit the biggest ones, you're going to be the winner in the long run. And we really believe that you can win when it comes to taxes, and we can help you do that.
Absolutely.
So then there's the SALT deductions. Again, we just established 40K is the new top cap. Used to be 10K. But what happens if you're a big earner?
Right. This is where the phase out kicks in. So again, understanding how, you can control your income in some instances, right? Like, we know what your, if you're still working, we know what your base pay or salary is going to be. Bonuses can be, variable, but you have a pretty good idea of what your income's going to be. Then where you're less certain is, with the investment income, right? And, do we have capital gains? Do we have capital losses? How much, dividends and interest being paid out? You can control that to some extent, but the Roth conversions are absolutely in your control.
100%.
Right. So 100% of the decision of like how much income do I want to add into this year or future years, via the Roth conversion. Well, you control exactly how many dollars you want to do there. So again, I think this just comes back to the importance of having a plan and building a plan that includes tax projections.
Yeah.
Just critically important.
Yeah, because hypothetically, if you made $400,000 through all of your income sources, and then all of a sudden you did a $200,000 Roth conversion, well, all of a sudden you would have knocked your SALT deduction from 40K down to 10K.
Yeah.
So you don't want to do that. Right.
Yeah.
Now, on the flip side, the interesting thing, this cuts both ways. So usually in a taxable state, when you do a Roth conversion, you're going to have that tax associated with the state liability. Okay, great. That adds potentially more gunpowder to your deduction on SALT. So it works both ways. You just got to really understand the nuances.
Again, it's just the thread of the needle, right? Like making sure that you understand the bumper, so to speak, of that you're staying in that safe zone.
All right, we're moving on from taxes.
All right.
I'm sorry, Jim. All right, tariff mulligan, right? So we know that the Liberation Day was April 2nd.
Yep.
And here we are. We are now past the 90-day sprint that they hoped to get things accomplished within. Not quite there. So we're going to talk about the next steps. And I think the big thing that I have as a question mark is we went through look, there was all these dates if you watched our last quarterly update, you went through the whole different phases of the month in April.
Yeah.
And it was wild.
It was crazy.
And I went from being an old man to being somewhere in a middle-aged man. The question is, will the new tariffs create more wrinkles? What do you think?
It's hard to say, obviously, but it does seem like the market has become more resilient to the tariff noise, I guess I would say. I think that the noise and the uncertainty early on in April obviously gave the market some a real scare. But we seem to kind of gotten past that to some extent, and the market is a bit calloused to the discussion at this point, it seems. Again, still plenty of uncertainty, and who knows what's headed in the incoming weeks and months. Who knows what might get announced today? There might be a big announcement today after we're done filming this that that we weren't ready for. So it does. I would say some of the good news is it does seem that the market has sort of grown, a nice callus to the news and the noise there.
I think that's a good way to put it. So the hard work of these tariffs are starting to create calluses on our hands, and we're not blistering up as much from it. Right?
Correct.
I like that analogy. I think it's appropriate. I think that your situation is not as headline driven as it once was.
Right.
So which is good.
Yep.
Because the day-to-day craziness coming out on tariffs is not going to swing the market up and down as much.
Absolutely.
That seems to be true.
Right.
Where we go from here is still very much so up in the air. We'll talk about that in a moment. So I just think that, look, keep your seatbelt on.
Yeah.
Be ready.
Right.
Build a portfolio and a plan that's resilient to these types of things. They're going to happen.
Yeah.
And we're going to be all right, but you don't have to lose your mind. If anybody made big decisions in April,
yeah,
chances are they were probably ones that hurt them. They were unless somebody was coming in with fresh money at the right time,
Right.
which would have been fantastic.
Sure.
In hindsight,
Yeah.
I would tell you I was pretty bullish.
Yeah.
Not bullish, bearish. I was pretty bearish.
Yeah.
But we hit the lows, and then all of a sudden we've skyrocketed up. One of the best quarters that we've had in a long time.
Yeah. I mean, again, this just comes back to, and I'm sure we'll talk about it later, but building a plan, being, having a diversified portfolio that you're comfortable with the risk, allocation in your portfolio. And if you've done the proper planning work, that your portfolio and your income and your spending can withstand these, ups and downs. And it was a really frustrating time. I think it was very easy to be bearish because the headlines were just so negative, so consistently in early April, and the market was taking it on the chin. It was very easy to have some serious concern.
It was challenging, no doubt about it. So I'm not going to put you back through April here, but let's go to the next slide. All right, so we also featured this. This is a tariff history. If you look back, way back in time, you can see tariffs used to be a big portion of how the government would fund itself.
Mm-hmm.
And over the years, through globalization, it less and less so. Okay, and then all of a sudden it was like, okay, we are really going to amp them up to maybe nuclear level.
Right.
They are going to be big. Where we land, still don't know, but let's tell you what we do know. August 1st is the new deadline. That's not to say it couldn't change for negotiating the deals. 10% tariff applies across the board with the exception of cell phones and computers.
Mm-hmm.
China, as we've mentioned before, which is the big 800-pound gorilla in the room.
Right. Yep.
They're at 30% right now. And I thought this was interesting and worth noting. June, we brought in $30 billion in tariff revenue.
That's real money.
Compared to $10 billion in March, with 3x.
Yeah, I mean that's real dollars. And again, the economists are trying to forecast what are the implications of this in the short, intermediate, and long term. That part is still very much up for debate. But to your point, this is what we know now, and the whole China trade deal in the middle of the quarter certainly was one of the inflection points for the market's confidence, moving forward, that it seems like there's progress being made there with that 800-pound gorilla, right, which I think certainly was part of the the tailwind that the market saw in the last 2 months of the quarter.
I think so. I think you're right. Which leads us to the next slide, which is, okay, what about the Fed?
Yeah.
So put simply, you've got Trump on one side saying, hey, the Fed should cut rates, which quite honestly and bluntly seems like a ludicrous idea.
Yes.
Okay.
Yeah.
And then on the other side, you have Powell, reserved, data-driven. He wants to maintain a full set of optionality for the future.
Right.
I mean, there's no doubt where I align on this thing. I think he's taking the right approach. Powell is.
Yeah.
By just kind of being data-driven and seeing the day-to-day on it.
Right.
So, he's hit the pause button on every opportunity here in recent history to cut. But that's not to say that he's not going to cut.
Right. Yeah. I mean, I think in looking at it, I certainly don't like the back and forth in the media around this stuff. That really is bothersome to me. But I understand, as of right now, the tariffs haven't created the inflation at this point, at least, that many economists projected that we'd be experiencing. So you understand the Trump camp saying we want rates lower because if you're looking at where we're at from a historical perspective, we are in a bit of a restrictive policy still from the Fed's side, right? Like, I'm not saying that we need to cut, or that there's going to be like 200 basis points worth of cuts, but there's probably one or two that would make sense in, air quotes, normal times. But these tariffs, as we just saw on the previous slide, are unlike tariffs we've experienced in 80 years. I mean, the numbers were back to like the 1940s where they were, close to a number level. Yeah. So I understand Powell wanting to maintain some flexibility here. And that being said, we've had this market rebound in the face of a slightly restrictive Federal Reserve. Right. We've still had, we're now at, the markets are up for the year, international more so than domestic, but we're still up for the year in a slightly restrictive Federal Reserve policy stance. So,
Great point.
you
And if
know,
you look at the slide here for a moment, the gray bars that are intersecting there with the blue every so often, those are recessions.
right,
So, typically the tool that the Fed has at their disposal during a recession is rate cuts.
correct,
So we're not in a recession, number one.
right,
Right?
yep,
Okay. We are in a slightly restrictive mode. I agree with you, right? But we're still not in a recession. There's no indicators that are saying we have an imminent recession on the
correct,
horizon.
correct,
So the economic indicators are still strong. Less strong GDP than in the past.
Sure.
But let's be honest, we are so stimulative since COVID
right.
that there's probably
Some cooling off,
a cooling off and a reckoning back to the mean.
Yeah, right.
So
I would absolutely agree with
you're
that.
not at 3% anymore, but you're at 1.5% growth.
Yeah,
Would we like to see more? Sure, right? But we're cooling down a little bit. So I just feel as though it seems like they're taking the appropriate tact at this point.
Yeah.
And we're going to see whether they'll have that ability to cut if we run into any unforeseen issues.
Correct.
And I think that's going to be really helpful to us as a backstop if troubles
absolutely,
really, really fly in the face of with all these tariffs.
absolutely, totally agree.
All right, a little bit more fun here than tariffs.
Yes.
So this is some of the good news. What we want to say here, we'll talk about these pictures for a moment. It's really important that you all, are out there having a good time this summer and using some of the hard-earned money that you all have made.
Right, absolutely.
I mean, that's what some of financial planning is all about, is making sure that you have the money to do the things that you want to do. And I know for us, part of that is vacationing.
Right.
So I'll start with mine. My vacation was interesting because it was with my dog, and we went up north. My wife, who is featured in the left-hand side there, she's with Willie the Wildcat, so that's at Kansas State University, where she's getting her doctorate. That's where I got my master's at. She seems to be a little comfortable there.
He does look pretty comfortable with the Wildcat.
I don't know if I should be worried. But we had a great time going up north. We were up in the UP up in Marquette, and it was just fantastically beautiful. What you're doing is seen is a picture of Marquette and Lake Superior.
Yeah,
it was awesome.
That's really cool.
But that sort of pales in comparison to you guys. Tell me about that.
Yeah, so we had a really, we're very fortunate. My father-in-law was born over in Italy, and he still had, he didn't move over to the U.S. until he was 10 years old. So he still has a lot of family back in Italy. So, my wife growing up, her family, they went back to visit, my father-in-law's family on a relatively frequent basis. So she's been over to Italy many times, and this is the first time that we took the kids. But we have, 2, 4, and 6. James is 6, Cece's 4, and Sophia, the little one there, is 2. We went over to Pescara, which is right on the Adriatic coast. So we flew into Rome, and it's a straight shot across the country right to the Adriatic coast. And it was just a really wonderful experience. I mean, to put it, very simply, it was a wonderful experience for the kids to get away from home and fly overseas and experience a different country and the culture. And the fact that we're able to do that vacation with family, and experience the culture in those, in a different country, it was not a very touristy vacation. Although you do see some pictures. We did the last 2 days. So we drove back over to fly back out of Rome, and so we spent 2 days in Rome. And my son was really excited to see the Colosseum and the Vatican. So although we did have a couple touristy pictures in here, really, the picture of my wife and I at the top middle of the screen, that was far more indicative of what we were doing, which that was like a big family dinner. It was like we had a big porchetta that was just delicious, and there were I don't know, there had been 15 tables that we had filled with friends and family from the area.
It's incredible.
And it was very cool. Lot of great food. The travel went very well. The kids were great. So, just very fortunate to be able to have the opportunity to have a vacation like that.
Sounds like one of those Stanley Tucci kind of moments.
Yes, exactly.
So very cool. I'm so happy for you guys. I'm glad we're all worked out and everybody's had just a fantastic time. You guys had great weather too.
We did. I mean, incredible.
Okay, back to earth here.
Yeah.
But still good news.
Right.
We've talked about this before. Consumer sentiment, consumer confidence, as gauged by University of Michigan over many, many years. And the interesting thing about this is that, usually when sentiment is low, post those low points in the sentiment gauge, the troughs,
Yep.
we usually have really, really good markets.
Yeah, right. It's like the inverse, indicator, right?
Exactly.
So,
Exactly.
you look and see we're still at a low point,
Mm-hmm.
right? I mean, it's we're not back to the long-term average from a confidence perspective and sentiment, but we're off of the lows,
Mm-hmm.
and it just again, it's interesting to see how far down the sentiment goes. Typically corresponds with much better looking forward investment returns.
Yeah, so by this indicator, and it's just one of many, there's more runway for good market opportunities here.
Definitely.
So we keep our eye on this one. We really believe in this one. The other thing that we think is super interesting is AI. Of course,
That's the big buzzword, right?
I mean, it so is, but it has played a big role. If you go back a couple of years ago, we were teetering on a recession. It was probably when ChatGPT came out, and all of a sudden all this, investment started taking place in AI.
Right.
It's real. I mean, on the left-hand side of the screen, you see the CapEx from the major hyperscalers, Google, Amazon, Meta, Microsoft.
Right.
Kind of like leading the charge.
Yep.
Among some other companies as well in this environment.
It really has been a huge buzzword, AI, right? And what are the practical applications of it going to be? I think it's very easy to see that we are still very early in the AI game, so to speak. The baseball's the frequent analogy that you get is like what inning are we in?
Yeah.
Right, and it certainly seems like we're at the very beginning of this.
I mean, we're first
game.
inning for sure.
Yeah.
That's not to say that it's not having some meaningful impact, not just in market momentum, but in actual business like usage.
Right.
I think it is.
Yeah.
But it's still just so early.
Yeah, it's impossible to know all of the potential and future implications of what AI is going to be able to do for productivity and all those things that might be able to add to profitability for companies, and it's obviously something that we're keeping our eye on, but it's interesting to see the hyperscalers are still spending a bunch of money on this.
They are.
Right. I mean, these are real big dollars that they're putting into this.
These are significant dollars. And it's also spilling over to other sectors. So this is not just in the information technology sector. Of course, they're leading the charge. But as you can see on the right-hand side here, you look at all these different sectors, it is having an impact elsewhere.
Oh, absolutely.
And the future for continued investment and reaping rewards from the artificial intelligence implementation is still very much so strong.
Right.
So look, we think innovation is always a good thing for the marketplace, and we're in the midst of this boom. We're going to want to ride that wave as much as you can, and it's just spreading out across many sectors now.
No question.
The other bit of good news is this is just a year to date on the major indices.
Right. And so what's interesting here is to see, and I think this is one of the things that actually was, if you think back to 2022, like that was a real stinker of a year.
Yeah.
Right? Because diversification didn't work the way that portfolio construction is meant to work. Right? Because you had all this inflation, you had interest rates being increased at a rate and a pace that we had never seen before.
Yeah.
So the increasing rates hurts bond prices. Well, oh, by the way, the stock market was getting kicked in the shins, and so there was nowhere to hide, really.
No.
Well, what was nice to see when we were having the market turmoil in the first 4 months of the year, you saw international stocks doing well, even though the domestic equities here were not doing so well. Fixed income was holding up well also. On a relative basis, it was looking really attractive.
Yeah.
So my point to that is just that diversification really has worked this year, and now everything is sort of bounced back. And again, you talk about this like rapid recovery we've had after the Liberation Day tariff announcement and the market turmoil that ensued after that. Those handful of days that were just terrible day after terrible day after terrible day. It didn't seem like it was going to end. But we're now back positive on the U.S. stocks for the year, and international's leading the way. So you've had a dollar, a weakening dollar, which has certainly helped, function as a bit of a tailwind for the international stocks, both developed international and emerging international stocks. So, look, it's been a good market year. Although if you hadn't paid attention to your accounts or paid attention to the news for the first half of the year, you would have been like, oh, nice, all my accounts are up, but you would have missed the fact that we had almost a 20% decline from the S&P 500 in that time frame.
It just doesn't do it in a linear fashion. This is a great slide for showing exactly how it really works. I mean, you're going along, and then all of a sudden you drop off a cliff.
Well, and I think one of the most important things to think about here, I know we've talked about this slide and showed a slide before that shows the best days in the stock market typically are tightly correlated to the worst days in the market. Correct. Right? And so it's that is the reason that you can't go all in and all out, right? This whole into the market, I'm in because things are good, or I'm out because things are getting bad. That strategy just has never been proven to work. And nobody's been able to time when to get out, when to get back in. And to see how quick the recovery happened there in April and where we're at gives more objective data to support the reason why you stay in the market.
I love that. And just talking specifically to the slide a little bit here, you can see at the bottom the orange and the blue and the purple. Those are S&P 500, Dow Jones, and NASDAQ. Pretty tightly wound.
Yeah.
Right? I mean, you're running 4.5 to nearly 7%.
Right.
And nothing to be upset with there halfway through the year.
No, absolutely.
And then the top two in pink and green, that's emerging market and developed market, right. International.
Yep.
And those have just been kicking butt, obviously. And we were talking about this earlier. Look, we made the call a couple of years ago that we thought international was definitely something you should have an allocation to in your portfolio.
Right.
At times it felt like we were a little early on that one, but I'm just happy to see that this cycle is seemingly coming to fruition. Traditionally, these cycles would go in 7-year stints, as it is.
Right.
7 years, you'd have international beating domestic, and then the domestic would beat it for 7 years.
Right.
Now, that hasn't rung true since the great financial recession, but prior to that 7-year cycle was very consistent.
Very much. No,
and here we are. Maybe we're in the midst of a cycle change. I don't know. Right?
If we did know, say. If we did know, that'd be great, but no, we never know.
But nevertheless, it's nice to have allocation to sectors that are doing 14 and 17% for the year.
Absolutely.
And as we always show you the periodic table of returns, this is always a favorite for us as asset allocators in the white, and it kind of follows that with the charting is a 60-40 based model portfolio, right. 60% in stocks, 40% fixed income. Look, it's having its heyday the last few years.
It really is. Yeah, you look at 23 and 24, and year to date in 25, the asset allocation has absolutely been a great place to be, which is giving more credence to the point that I made earlier of diversification was really working this year. Yeah. In 2022, not so much, but here in 2025, it's absolutely done its job. And again, I just you can cherry pick so many different data points out of this that are valuable piece of information to have. But if you were to look at the 2024 column on the far right where we have it boxed in yellow there in the middle, it developed international was the second worst returning asset class in 2024.
Yep.
It's number one year to date, right? So again, it just goes back to, did we know when it was going to take hold and become the top returning asset class for some period of time? No, we didn't. But the setup was there for it, and it's just another reminder that what worked for you last year might not be what works this year.
Exactly. So always important to see this, and it leads us into our next slide.
Build a plan.
Build a plan. Let's make that plan together. So we're both certified financial planners. we believe in the art and science of this discipline, and it all starts with understanding the individual and then building around that.
Absolutely. And if you don't have a plan, it's easy to make some really emotional and potentially very harming decisions from a financial perspective.
It has got to be that ballast for you, and that strong point that you can kind of always look back upon and say, how am I doing against my plan? Is this really impacting my future self?
Right.
What's going on in today's crazy world?
Right.
Or is it just another blip on the radar screen like so many of them are?
Correct.
Right. So, like they say in baseball, you try not to, if you listen to the Tigers at all, which I'm a Tigers fan, they're the top team in baseball right now. AJ Hinch is their manager. He's like, listen, we try to keep our guys even keeled. Don't get too high, don't get too low. There's 162 games throughout the year, right?
Right.
You cannot get too emotional. Investing is really similar to that.
Absolutely.
So we try to stay even, think long term.
Absolutely.
Well, thanks again, Jimmy.
Thank you, Jeremy. Appreciate your time.
Appreciate it. And if anybody needs any help from us, On Track Wealth Management, we're going to put our contact information here on the next slide for you.